All right, be the market expert. Let's get this thing rolling. Wanted to kick it off with this. Obviously, this is not real estate related, and yet this goes into every conversation that we have, and it's being that real estate economist of choice. We know what sells the news, right? It's doom, it's gloom, it's chaos, it's the next bad thing happening. And what's interesting, if we look at this thing, this article, it says Americans trust the Weather Channel more than any other news source. It says the Weather Channel has 49%, BBC, PBS, Forbes, ESPN, the Wall Street Journal, right? And it just keeps going down and down, lower and lower. So I bring this up to say this. This is why when we're going out there and we are being the conduit for the real estate information that the people that are in our ecosystem care about, guys, like you have a huge opportunity to take massive, massive mind share. And so when we're going through, and we know, especially here in Colorado, that they do not know what the weather looks like tomorrow or even later this afternoon. And yet this is one of the top news sources in the nation. This tells us that there's a huge opportunity, right? We should be leaning into this thing as much as we can and be putting out as much information about real estate as humanly possible and really just lean into being this, this social media content director first and then real estate agent second. So let's go into this. And looks like a bunch of ads will keep popping up on here. And so we are just looking at this one graph, and this is a most affordable cities to buy a home in 2025. And I'm going to enlarge it a little bit. So what this graph is doing is it's a 0 to 100, 100 being the most affordable city and 0 being not so awesome. And so what this is doing is this is going through, and we can kind of take a look at it. And we own two. We own two of these, which is kind of interesting. So 2 of the 20. But the most affordable in the United States, right? The most affordable city in the United States right now is Detroit. And they give it a ranking of 73.42%. We'll get into their rankings here in a second. Pittsburgh is 73.3%. And so if we look at this, but Aurora, top 20, 64.82, with Colorado Springs being 65.05. So we're looking at this kind of interesting information, but let's look into how they got there. So if we're looking at it, it says Detroit tops the list with a score of 73.42, reflecting the highest affordability in the country. And then the Rust Belt dominates the list, with Pittsburgh and Cleveland offering strong values for home buyers. And then southwestern cities are gaining ground with Las Vegas, Henderson, Mesa, Tucson, or Tuscan, Phoenix making up the top 20. So what it's going through is it says that Wallet Hub. So Wallet Hub's the source that put this out. Said 300 U.S. cities of varying sizes across 10 metrics: real estate taxes, cost per square foot, median home price, median household income, right? They're going through all this, and they gave it scores of 100. So kind of interesting when we go through, but here's the different visual of this. So again, we scroll through. Colorado Springs, number 17, Aurora, number 20. But as we're looking at this, this kind of goes hand in hand with kind of what we talked about the other day, right? When we're looking at what the average home price is in our states, couple that with what the hourly rate is for a salary, and we get some interesting numbers. So it says today more than 22% of homes in Detroit are vacant, creating a strong buyer's market, according to Wallet Hub. It says Detroit is also one of the top cities where buying a home offers greater long-term value than renting. The city was also considered the most affordable large city in 2025, according to another study. So I don't know what this really means to a whole lot of people, but yet if we're looking at this thing, I don't think that I'm going to rush to Detroit, but yet it looks like there's some opportunity in Detroit for a valuable home if anyone's looking. But let's go into this next one, because I think that when we're talking about real estate news, this is something that is top of mind, I think, for most all of us. It says Zillow will begin banning non-compliant listings starting on June 30th. All right, cool. So we got June 30th. And when we're looking at June 30th, which is only a couple weeks away, right? We're talking about the end of the month. What we have is Compass, right? And this is what we've been talking about. And so right now they're playing a game of chicken, right? We got Compass and we have Zillow. We have Compass, which is one of the largest brokerages in the United States. And we have Zillow, which is the largest syndicator of properties in the world, right? And so as we're looking at this, what we can look at and see is Compass is taking the stance that they want to have in-house brokerage exclusive listings. And Zillow, how Zillow makes their money, right, is they bring the listings through and then they have consumers raise their hand and then the consumer becomes a lead. They sell the lead to a real estate agent. And that's what their model looks like. Well, so then when we're talking about their model, right, what has happened at this point now is when we go forward and we start looking at it, then what we have is we have Compass popping up and saying, but no, listen, we get that you're a big syndicator. And yet we actually think it's more advantageous for our agents to have a closed loop for our consumers only. And Zillow says, cool, rock and roll. Go ahead and do that. If you guys want to have a closed loop, you can do that. But here's the thing. If you start your property in a closed loop to where only it's going to syndicate inside of your data, we're not going to push that data out to our pool, the largest pool in the world. We're not going to syndicate out that information. And so that's kind of where we are. So both companies, neither one has changed their stance. Zillow is saying, hey, we will not push any information that is in a closed loop to start. And we have Compass saying, well, hey, look, we're still going to continue down this path. And it's like roughly, I think like 6% is the latest number that I saw. 6% of all Compass listings right now are in that closed loop to where only Compass agents can see this. And this has been their play, right? We're going to continue to watch this. This is going to be very, very interesting to see what happens because obviously Compass can do what they want to do. And they've actually sent out disclaimers. They actually have a disclaimer now that their consumers have to sign. And their consumers have to sign that says, hey, like we understand the risk and the potential benefits for having our listings in this closed loop. We've also have seen Zillow going through and they're like, listen, we're not going to lose any sleep over this. So we'll continue to monitor this and see, you know, firstly, based off of what we've already seen, that when we have these privately syndicated inside of a exclusive into your own brokerage, we've actually seen days on market go up and no real significant price increases. Like we haven't seen anything that has merited this, like this is a win for our consumers, but Compass is going through and they do believe it. So we'll see what this kind of looks like. Then let's switch over to Denver. I did see this article today. It says Denver housing market is hit with an explosion of listings. How far could home prices fall? All right, so first and foremost, nobody has a crystal ball. Nobody. And we're looking through and it's talking about in April, active listings in the Denver metro area hit 10,354, which was up 65% from a year ago. And so when we look at this, let's just scroll all the way down. And let's look at April 2025 inventory, and we can see this. So here's your visual representation of the Denver Metro, right? So we can see 2024, 2023, 2022. This is weird, right? So when we're looking at 2022 data, I think that we need to keep in mind this, that in the first half of 2022, we had low interest rates. And the second part of 2022, we had higher interest rates. Now, the reason why we saw some weird stuff happen as quickly as we saw it was because of the speed to which the interest rates rose. They went up in a trajectory that was higher than we've ever seen in the history of mortgage rates, right, in the United States. And so that's actually what scared and backed a lot of people off. Obviously, we know 2021, we had very low interest rates. In 2020, we were in a global pandemic. So we have 2020 global pandemic, 2021, unheard of low interest rates. First half of 2022, still low interest rates. And then it skyrocketed 23, 24, higher interest rates, 25. We've kind of leveled off, went down a little bit and leveled off. And this is why we're sitting where we're sitting. It says also, meanwhile, rent in Denver is falling quickly, with the median asking rent in April down 7% from a year ago. It says following a boom in multifamily construction. And so that's what we've seen, right? Like when we're looking around, we're not seeing a whole lot of single family housing developments being built. What we're seeing is multifamily. And in Colorado, with our construction defect laws that we have currently, that's why we see more apartments than condo. Yeah, it's just as advantageous for them to build a condo, but yet, if they were to build condos in this multifamily construction setting, they also have construction defects to where they can be sued down the road, and that's what scares a lot of them off. So that's why we have more apartments than condos in Colorado. So we're seeing the rents fall, right? So we are seeing this, and it says the CEO of the Reventure app, which is just analytics, tells Realtor.com that he believes that the Denver market is now headed for a correction and forecasts the median home values in the area to fall 9% over the next 12 months. We already looked at the Reventure app, right? Like this is old news where this guy is doom and gloom across the nation and is just predicting the market collapse in every single state. And this is why the Weather Channel, again, is the most trusted news source in the nation right now. So we look at this thing and it says, also, guys, we have a weak condo market. Yeah, we get that. We know this. All the data says that while we all want listings and listings is good to have and might as well get a condo, we need to make sure that we are strategically pricing out condos, right? If we're not strategically pricing out condos in the current market that we're in, with the HOAs being what they are, condos are sitting. It says over the past 12 months, an average of 34% of active listings in Denver metro were attached homes, 5% up over last year. Nationally, just 22% of listings were attached homes. And this is a gain of only 1.5 percentage points. So we look at this thing, and it also goes further a little bit more, but here's your median price points. So if we're looking at this, we can actually see that for an attached home, the median price point, again, in the Denver metro, and median, right? We're taking out the high price, we're taking out the low price, and we're making our way into that middle number. For attached homes, right, we're looking somewhere in high 300s, right below 400,000. And then in the single family right now, we're sitting above $700,000. So let's think about this. Firstly, where Reventure's going, right? Because this is what's frustrating about this kind of news. They're saying 9%. All right, so they're saying 9%. And so between friends, let's just call it 10%. 10%, they're saying that we're going to see price corrections fall $70,000 on a medium price point home in Colorado, in the Denver metro area. So 70,000, they're saying that we're going to go down to $630,000. All right, be thinking about this even more strategically. When we're looking at this, there's only really one segment of people that really are putting their home on the market, and those are the people that need to. Those are the motivated. And so when we're looking at this thing, what I do think is there's also probably some people that are looking to sell their home for fun, right? They're going to sell their home. Maybe they want to trade and do something. The people that are selling their home, either they have equity in their house and or they're having a life event that's going to force them. So yes, there's going to be some people that could get injured financially speaking because of this, right? $70,000 haircut off of a $700,000 home. If I bought my house anywhere between 2022 and today, that's probably going to hurt. But then I think we have to think about this. Also, what do we have? We have people that bought their home in the early 2000s, in the 1990s, pre-2020. They have massive amount of equity in their homes, massives. And so when we're talking about potentially seeing this price decrease, firstly, we know it's going to take point, it's pockets, right? We have pockets of areas to where they're not going to see a price decrease, but they're still going to have multiple offer situations. And then we're going to have areas where there's multiple homes for sale, where those guys are their only competitions themselves. And so when we're looking apples to apples, I got to be the cheapest home. Then when we look at the attached homes, let's call it 400,000. Again, let's go up to 10%. But again, I don't know if that's super realistic. We're saying 40,000. So now we're going down to a $360,000 price point. Now, those people I think could be hurt a little bit more only because condos don't appreciate as much as a single family home does. But again, I don't think the ReVenture app, like as we're looking at this thing, and I could be wrong. Again, I don't have a crystal ball either. But as I'm looking at this data, there's nothing really here except for what are we seeing? We're seeing homes sit on the market. And you only lose money if you sell your home. And so then what we have to keep in mind is, and you guys know this, like the people that you guys are talking about, your active listings, be thinking about this. What are my active listings doing? Are my active listings, are they moving out of the state of Colorado? Do they have to move out of the state of Colorado, or are they just bailing to cash out an equity? Right? Like these are the things that we have to keep in mind. Like, again, the only people that are going to be forced to sell their house are someone that lost their job. And I actually don't think that we're in that market yet. Yes, people do lose their jobs daily. Like that does happen. But yet we're not in a recession. And so when we're talking about the recession is the only thing that I can think about that where multiple people lose their job, we're going to have a knee-jerk reaction to where they're going to have to sell their house because now they're not making their mortgage payment. The mortgage company is going to call their note due. They're going to have the acceleration clause kick in, and then they're going to claw back the home. But again, we've seen forbearances. We've seen all these other things. Like, I don't believe this looks like 2008, right? 2008, again, we had people that were super unqualified with multiple homes. We saw zombie foreclosures on the rise because we actually had houses that had never been lived in, but people just got an extra mortgage for the sake of getting an extra mortgage because it was like your Kohl's credit card, where if you open up a credit card, they give you 10% off. Same thing with the mortgages, right? It was just like, hey, if you want a mortgage, I'll give you one. And you're like, well, I don't need an extra house. And they're like, it's cool, get one. That's why we were in the housing crisis that we were in. So I think that there's actually probably going to be more stuff in place for banks not to claw back these houses because they don't want to be in the real estate business either. So again, we'll continue to monitor this, but I don't think that this is as big of a deal as we're looking at this thing only because we're not in a recession. Yes, housing, our segment, we are in that recession. We're not growing, right? We're actually constricting. And yet, I don't think that the banks are in the business of this. It says how Denver sellers can navigate the soft market. Well, here's the thing. Don't put it on the market unless you need to sell. You only lose money if you sell. And so I know that's probably going to be the conversation that we're going to be having, guys. We're going into summer. It might not feel like summer because it's been freezing and rainy over the last couple of days, weeks even, but you're going to be going to barbecues. You're going to be going to graduation parties. You're going to be going to a lot of stuff. And as the real estate economist of choice, because again, the most trusted news channel is the Weather Channel right now, and you being the real estate economist of choice. And as we're going through and we're looking at this thing, this is why we need to be educated. This is why we need to affirm our own opinions to be able to have a conversation with people and be like, listen, like, here's the thing. Yes, we do have more homes on the market than we've had in recent years. And yet the people that are selling are the people that are motivated. They have another life situation that is happening that is having them sell their home to move on to another chapter in life. The only people that are going to lose money are the people that need to sell, that have bought their home in the last couple of years, that bought at market highs. With that being said, I think the biggest thing that we need to keep in mind as we are having these conversations is there's still pockets. right? Like we don't know, and not all homes are created equal, including the areas to which the homes are, to where we know that there's still multiple offer situations out there. There's also pockets where homes are sitting for 120 days. And so not everyone's in the same boat. And that's going to be up to us to ask the right questions when we're at these, while we're at these picnics and or parties, and when people are coming up to us as we're taking massive mind share so that we can outrank the Weather Channel. This article also popped up, and I was talking to Bob about this because this article's stupid. And this is what I think about when I look at this. It says Redfin. All right, so Redfin's the one that produces. And again, Redfin's a big third-party aggregator of information, right, underneath Zillow. And it says US housing market now has 500,000 more home sellers than home buyers. So I saw this article, and Bob and I were talking about this yesterday morning before coffee talk. And I was like, I get how we can extrapolate the data for how many listings there are. But how in the world are they finding out the buyer pool? Like, where do you get that? Like, where are people signing up that says, I am a buyer? And we were kind of thinking about this, and my working hypothesis at that time was they were looking at purchase application data, right? They had purchase application data and they were extrapolating some number. So it goes, the longer we've remained in this strained housing demand environment, the more the number of sellers is outmatching the total number of home buyers. And again, guys, the American dream is not dead. The issue is the cost of money is so high that what we have now is we have people staying on the sidelines waiting for the perfect house. I actually think that's where we are right now. And I think that as you're having conversations with your people inside your own ecosystems, that's what you're going to find out. I think I told you guys this last week that I was having a conversation with one of the largest lenders in Colorado. And what they were saying was that they're actually having conversations with people getting purchase applications and going through to see what they qualify for. And they're waiting on the sideline for the perfect home, their forever home. And it's like, think about that. I want you guys to think about that for where you are. Like, is anybody in their forever home right now? Like, I know I'm not. I know I might not even be in my forever city. I've been in Arvada for a very, very long time, but I don't even know if I'm in my forever city. And so when we look at this, here's their data. And this is estimated number of US home buyers and sellers actively in the housing market. Well, again, sellers, that's pretty real. Outside of like some data like for sale by owners, not advertising it, like this number we can pull from the MLS is like, I'm down for this number, 1.9. I'll buy it. But then when we look through, it says we have 1.4 million home buyers. So I'm looking at this thing and I'm like, this isn't really lining up. And I was getting really interested on where they were getting this information. It says most of the softest markets, Texas, Florida, Colorado, Arizona. Well, Texas, right? We know in the Sun Belt, we know the Sun Belt, Texas, Florida. We know all three of those, even though the Sun Belt isn't a state, but we know what happened, that we had the digital nomads. They were flocking to these areas because of the cost of living, quality of life, everything that we were looking at, and the affordability. And they were saying, awesome, I can keep my $100,000 a year job, work digitally in a state where the median salary is $60,000. I will be living large. Well, then what happened is these builders in these areas, they were like, if we build it, they will continue to come. And then we hit this correction with our interest rates, with the cost of money. And now the cost of money's gone up and we don't have people flocking to these areas as quickly as they were. Colorado, we're just in a weirder situation. In Colorado, we have a very, very high price point, one of the highest price points in the nation. And when we're talking about our price point, where we're sitting at, coupled with the cost of money, that's why we're seeing it slow down in Colorado as much as it is. It's not because people don't want to live in Colorado. I was talking to Patty on Friday out on the patio, and we were really just talking about what it looked like in Colorado, even with our weather. Like, we have some of the best weather. And we were actually talking about Oklahoma and tornadoes and all that stuff. And we were like, why would anyone want to live in one of those areas? And I was like, I think I could do it. And she's like, Colorado's way too great of weather for these people to be given up on. And then Arizona, same thing. We see a lot of people going in higher price points in a lot of these places in Arizona, cost them money. This is kind of what it looks like. So then I'm looking a little bit deeper, and it's like home sellers versus home buyers and the difference, right? Percentage wise. Let's scroll down to Colorado because that's where we care. There's Denver, and it's saying 16,000, right? There's your home sellers. And then we have 11,000 home buyers, and they're calling this a buyer's market. Here's the thing, we're not in a buyer's market. The buyer's market data that we traditionally talk about, because if your people see this is what they base buyer's market off of: days on market. Like that's what it's based off of, like how much inventory that we have and how long the inventory sits. And it's actually, unfortunately, a super antiquated model, because right now, well, I want you to talk to your sellers. For any of you that have a seller or someone that's thinking about selling their house, ask them what market they think that we're in, and ask them if they were to put their home on the market today and someone were to offer them 10% off, like the Reventure app thinks that they're going to take, if your client would. Because if they're saying that they wouldn't do that, we're not in a buyer's market, guys. Their buyer's market data, they're basing this off of months of inventory, supply of inventory. That's what they're basing this off of. But I don't think that the mindset of our sellers right now is of a buyer's market. Then they go through a balanced market, right? To where these numbers are a little bit more even, which again, I don't think is the way to do this. And then they reverse it saying listings versus sellers. Basically, all these numbers boil down to how many homes are on the market, how many buyers are out there, how long are homes sitting on the market. That's how they extrapolate this data. But again, I still wasn't convinced. I'm like, this is still pretty stupid to me. Where are they getting this from? So then they break it down. This is their methodology. And the fact that you have to get into this big of an explanation for a calculation tells me they massage some numbers. All right. So on the sell side, they're like, all we did was we took the active listings or the total number of homes actively for sale during any given month. Cool. That makes sense to me. 100%. 2 sentences. We counted the number of homes for sale. Perfect. Got it. And then I was like, all right, well, how do we get this buyer information? And half a page later, where you go through in this font, it says, this metric actually isn't very similar. What we did was we guessed. Like literally, if you were to read through all of this, that's all it said is like, we took information based off of how long stuff was happening, and then we pretended like this is how many buyers after how many times they tour a home, and we multiplied those, and they figured it out the way that they wanted to figure it out. So I would say this: if you see this circulating around, which it's all over social media, if you're in some of these real estate Facebook groups, this is garbage. This is someone that put together their own metric for a metric that we have never tracked before. And they have just guesstimated what they thought. And then they assigned values based off of home buyers to home sellers to buyers markets to balanced markets to sellers markets. And it's garbage. But let's do this. Let's go into Housing Wire. Let's talk about national data. Let's talk about Logan Motoshami, the lead analyst, right? Oh, actually, we're not there yet. We're in the America's tapped $25 billion in home equity. This actually I did think was interesting as well. We'll get to Logan Motoshami next. When we look at this thing, it says $25 billion in home equity has been tapped. And so we look at this thing. This is your second lien mortgages. These are HELOCs, guys. So we're looking at this thing. This is the second largest for this period in 17 years. And we're looking at this thing. It says this market, that marks a 22% increase compared to the same quarter last year. So we're seeing 22% year over year change quarterly for people tapping into their home equity. And when we're looking at this, this is what's very interesting. We have some of the best balance sheets that we have had in almost forever, right? Outside the last couple of years, we have some of the best balance sheets when we're looking at people with equity in their home. Be thinking about this, guys. Like for those that haven't been in this or haven't been a home buyer, I want you guys to really go back to like 1999. All right, so let's go back to 1999. And homes in the Denver metro area, I'm talking like your big houses. Let's talk about like your 3,000 square foot West Arvada houses. Those homes were going for like $300,000. Let's fast forward. I remember buying my first home in 2008 in Scenic Heights in Arvada. And it was a 2,500 square foot home that was a ranch for $250,000. Fast forward, the first home, these 1990 homes are worth somewhere in the millions. That home I looked, Redfin gave me their Redfin's estimate that makes me cry every time they send it to me, is around $800,000. People have huge amounts of equity. And I want you to think about the people that have been sitting in their home since the 70s and the 80s, or the people that inherited their parents' homes and they've just been sitting on them. Guys, we have huge numbers of equity in these homes. And it says the first quarter is typically the slowest for home equity lending, but lower interest rates in the early 2025s helped boost this activity. So interest rates did go down a little bit. They're not low by any extent of the imagination. But what people are doing is they're getting HELOCs that have dropped by 2.5% percentage points, right? So you subtract that 2.5 from there, and it dropped below 7.5 in March. So now people are going out and they're getting lines of credit. Now, hopefully their lines of credit, while this doesn't go through and it's not really outlining what they're really using this money for, hopefully it's something good and not something stupid, that we're seeing people go through and they're using their houses as credit cards. That's what this is doing. It says in total, US mortgage holders, all right? Guys, these are people that have a mortgage payment, which is not the entire population, have a record of $17.6 trillion in home equity. Guys, $17.6 trillion in home equity. So this is also one of that. And it says, as of that, 11.5 trillion is considered tappable. Guys, there are people that are able to use their home to be able to upgrade their house, to go buy a secondary home, to go buy an investment property, to turn their current home into an investment property and use that equity to go buy a new primary home. And these are the conversations that as we're looking at, it says as of, or about 48 million mortgage holders have some level of equity with the average. All right, again, the average, we take the total number, we divide up the entire, or we take the total number, we divide it up by the total amount of these 48 million mortgage holders. And they're saying the average person has $212,000 in tappable equity in their home. Guys, and as a real estate economist of choice, right? When we want to be better than the Weather Channel, and we're going through and we are being that real estate economist of choice, do we know the conversations that we should be having? And is this something that maybe we should know while we're at that dinner party and someone's talking? We say, yeah, you know what? Like we've heard all this doom and gloom about the market, but did you know that according to a recent survey from ICE, which is a mortgage company, that they've actually gone through and the average American that actually holds a mortgage has about $212,000 in tappable equity? And they're like, oh my God, I had no idea. Because everyone's just pushing, hey, home prices are going down, home values are going down, housing bubble. But they're not taking into account that these people bought their homes for $300,000 and now they're worth $1 million. And even if Reventure was right and they lost 10%, we're not talking astronomical amounts of money that they're losing. Yes, it would suck. No one wants to lose 10%, but they still have hundreds of thousands of dollars in equity in their home. So let's look at what Malokin has to say, right? So we're going to go look through this and it says, in one of the most chaotic weeks of economic headlines of the year, mortgage rates remain stable. And so we look at this thing and it says, in contrast to the madness caused by the Godzilla tariffs weeks ago. So we go through, this is last week's data, and we're going to go back a week, right? But let's look at purchase application data because I think that's super important. Guys, look at this. We did bump back up last week. You have consumers that are out there that are reaching out to lenders to figure out what they qualify for. This is more so than what it was in 2024. And when we're having these conversations, guys, being the real estate economist of choice and putting out the information to be better than all of these other companies. And guys, look at this. Like, we see ESPN right here in the middle. You don't see Fox News. You don't see CNN. I get that, Disney, CNN, Fox News, all those right are owned by the same company. But yet we're looking at this. How do we be the real estate economist of choice for when someone goes out and speaks to a lender that they're actually asking our opinion on what we think of the housing market? And we should be staying up to date to be able to form our own opinions, to be able to navigate someone through the largest financial decision that most Americans will make in their lifetime. And this number is super encouraging. And the only reason why this number would not excite you is if you're not staying in front of your people. And this is one of your people in your ecosystem that went out and talked to the lender without consulting you. And now they could be talking to another real estate agent. So what are you doing to take massive, massive mind share at this point, knowing that with all the doom and gloom that all these websites are pushing, that we could see Reventure app saying Denver's in for a correction at 10%, but yet there's people reaching out to figure out what their homes are worth, as well as they're figuring out what they qualify for. And how many of those people are reaching out to us? Like, what are we doing with that? Your pending home sales data, guys, we're still up. Like, we're getting close. I'm telling you guys, this is going to hit sooner than later. We are going to pass 2022. And again, we saw this dip with interest rates rising. People got scared and they stopped. So we're going to see this cross again. I do feel good about the summer. We're going to see this cross here in the summer. Your weekly pending, right? So it did take a little bit of a nosedive here. Like, we are dipping a little bit, but I don't think there's anything to be concerned about. Again, just the cost of money, things are happening. People are looking for homes that check box all of their criteria. But here we go. We're getting closer and closer to 2019. And 2019 is key data. Whenever we're talking about the housing market, we're going to base it off of pre-19. All right. Pre-19 was considered a normal market. Again, global pandemic, interest rates, right? Like, that's what this thing looks like. So when we're talking about normal markets, we're going to talk about 2019, but we have 33% more single family homes on the market than we did this time last year. And this is good. This means that if one of my clients is one of these people, and we're going into a neighborhood that potentially has 33% more homes for sale than it did last year, and there's more competition, and these people are motivated to sell their house, as with all the rules that happen with the NAR commission lawsuit, that we have so much negotiation power right now that we can be that real estate economist of choice, get in, negotiate a great contract for our clients, and help them win. This is good stuff, guys. So we're looking at this national single family new listings. We're right in the mix, right? It did drop a little bit, but like, we're still right here. I feel good about this data. Your price cut percentages, here we are. This should not surprise anybody, right? With more inventory on the market and more inventory coming online, the only way that you are going to beat the brand new listing that came on the market, if you are apples for apples, is to drop your price. 38% of all homes in the nation take a price cut. Now, for context, we know that 1/3 of all homes in the nation take a price cut every year. So we're not significantly higher. The only difference now is we have a lot of homes on the market. Couple that with, most of them are probably motivated to sell their house. And then when a new home comes online, the only way to compete is to get cheaper than that home. And that's why we're seeing price cuts. So then we're looking at jobless claims, because this is what is going to dictate the rest of our year and 2026, honestly, is that if we get into a recessionary period where we are seeing people lose their jobs, then this is when the Fed is going to start lowering rates. There's no reason for the Fed to lower rates right now. Again, we talk about what this looks like, the shots across the bow. We have the current administration, we have the Fed blaming it on each other. And that's just what's happening. The Trump administration saying that, hey, the Fed isn't lowering rates, that's why the economy sucks. And we have the Fed saying, Jerome Powell saying, hey, the Trump administration is tariffing these countries, and we don't know what that's going to do, so we're going to hold off. And that's where we are. We're at a stalemate with just shots getting fired across the bow. So if this number does not go down significantly, right, then we will not see rates get lowered. And again, we're not going to cheer on for jobless claims. We don't, that's un-American. We're not going to root for people to lose their jobs. But we do know in our industry that we are disproportionately affected when it comes to rates. And when we're talking about people buying houses, it's typically the more affluent. The more affluent aren't the ones that are going to typically lose their jobs. And so people losing their jobs in our industry is not necessarily the worst thing that happens. It's actually a good thing for our industry, yet we're not championing that. We're not looking for that to happen. It says Fed President Waller will speak on Monday. This was yesterday, and we'll have some PMI data to consider. Although the mortgage market remained calm last week, the upcoming week brings some volatility. Well, let's look at that first. And maybe this is where we will end. I have just 1 month's worth of data. I'm looking from May 3rd to June 2nd, which was yesterday. And as we're looking at this, guys, this is relatively flat. And so if you were on Coffee Talk yesterday, you heard Mitch say that, like, I think it was Mitch, it could have been Dale. And what they said was that a flat market is a market when we're talking about rates that what we want to see. And it's very, very true. When we talk about rate volatility, where we don't know what it's going to look like the next day or the next week or the next month or 3 months out, considering where we are, right? We are in a market where homes are sitting on the market longer. And so what we also know is most sellers become buyers. Well, if I'm a seller and I'm not super motivated, but I'm motivated enough to be thinking about selling my house, if I don't know what interest rates look like a week from now, 3 months from now, I might be more hesitant to hold off and not list my house because I don't want to go backwards. I understand that I have a 3% interest rate today. And if I get a new home, I'm going to be at 7. But I also don't want my purchase power going down more because rates turn into 8%. Right? So when we're looking at this, this is good. Well, yeah, it's a little bumpy. This is what we want to see. If we look at 3 months, yeah, it creeped up, but again, like, it's a pretty slow creep and it's pretty flat. We look at a year, this is where it gets scary. We look at 2 years, yeah, this is third world country. We live in the United States of America. We should be able to predict what the cost of money looks like as an American based off of what's happening in our economy. And so as we're going through and we're looking at this, guys, like, this is why the purchase application date is going up. Is that it's staying pretty flat, regardless of what's happening in the world right now and the news that's circulating around. And the only place that people trust is the Weather Channel, even though we know that the Colorado weatherman does not get the news correctly. And yet this is the #1 source at 49% approval rating. That when we're going through and we're staying educated and we're getting in front of people and we're having conversations, and mortgage rates are staying flat. And when we're at our next party to have a conversation with someone where they ask our opinion, this is the information that we should be giving them to help guide them for the largest financial decision that most Americans make in their lifetime.